Well, happy Monday again, and welcome to the last part of January. We're moving forward through winter. We're going to make it. We can do this. Today, I want to give you a little bit more hope. There's this thing called the Golden Cross or the Death Cross. It's a technical indicator on charts, and in this case, on bond charts, that shows the general trend over weeks or months of which direction interest rates may go. So let's take a look at this. Very interesting. I think you'll find this intriguing. So this is showing you the 10-year Treasury. And as you know, the 10-year Treasury is not mortgage rates, but is a leading indicator of mortgage rates and follows very closely. Mortgage rates follow this very closely. This is going back a year. And as you can see, the 10-year yield went up a lot, right, since last spring. And we know that, right? The 10-year yield went up, rates went up, right? And then it kind of turned the corner here in October and has come down. Now, what I'm talking about with this golden cross is right here where I've got this red circle. As you can see, the blue line represents the 200-day moving average of kind of where the price is. And the black line is the 50-day moving average. They crossed over last June, meaning this was a golden cross for the 10-year Treasury, meaning the yield was going to continue to rise, which it did. So we saw rates rise and rise and rise. However, that's turned a corner. If it will cross over the 200-day moving average here in the next couple of weeks, or days even, that would be called a death cross, which would be a good news, good thing for mortgage rates, right? And the death cross meaning the yield would continue to hopefully have this same pattern over a number of months, maybe even 6 months or longer, of decreasing yield and decreasing interest rates. So let's take a look at this, see how it looks on the mortgage-backed security side. This is the direct, right, bond that affects conventional loans right here. So where is our golden cross? Right here, here it is. So where I've circled it with this red is the 50-day moving average crossing the 200-day moving average. That happened a little over a week and a half ago. So if this holds true and this 50-day continues to stay above the 200-day, that could portend lower interest rates for months, right? Now, it doesn't mean they're going to fall off a cliff, but it could mean that we have continued pricing improvements where price continues to go higher. We want price to go higher because that means the yield and rate is dropping on mortgage-backed securities. So thought this was just an interesting little tidbit. Thought you might find it fascinating, and just one more little piece of good news to get us going through January so we can make it to spring at some point in the future. This Friday is the PCE, the Personal Consumption Expenditure Index, which is the Fed's favorite measure of inflation. So that's going to be a big potential market mover. I'll be commenting on that next Monday during this video. In the meantime, please, of course, feel free to follow me on Instagram if you're not already. You can find me at the Bill Zimmerman, where I'll be posting updates and various tidbits and factoids for you if you're a real estate agent to help you with your clients, and if you're a potential home buyer to help you make wise decisions regarding home ownership. I hope you found this interesting. Have a wonderful week.